Hey, morning everyone. Welcome back to Morning Kappa. Aiman here. Right, so for the China A50 futures, well, it dropped to 15,157 yesterday on Monday session as the PBOC kept the MLF interest rate unchanged, dishing out the widespread hopes for the pre-CNY stimulus cut for the boost liquidity. So also, you notice that selling pressure intensified after the Q4 GDP and also December data release, while the GDP met the target. I think the retail sales slightly missed expectation despite hitting 3.7%, which causing a slight sell-off in consumer stocks as investors realize the uh, consumption recovery story is there, but at slower pace. So I expect the A50 to remain weak and trending towards the 50,000 level today, right? And I think the market is now in a consolidation mode, punishing the central bank to not easing policy. And I think this will likely to stay heavy until the LPR setting next week, right? So yeah, looking at the WTI futures, well, it edged slightly higher at $59 level in a low volume trading as traders price in a new supply risk, which is the Kazakhstan oil export are facing delays in the Black Sea due to the uh, I would say bottleneck, logistic bottleneck, right? Um, Also tightening the physical market for the light crude. So yeah, gains were capped by the demand fears after the Trump uh, threatened the new tariff on the European goods. On the I mean for the Greenland story, right? Which also adding the gloom from the China's weak data. So expect the volatility um, to return today as US traders return from the holiday, and yeah, I think the market need to decide if the Kazakhstan outage is big enough to counter the strong dollar pressure from the sticky inflation outlook. Well, I think for now, we keep our bullish position unchanged, keeping an eye at this $62 level together with the $65 level, while the stop loss remains firm at 58 dollar level, right? Also for the Malaysian market, if you look here at the chart, the KLCI, the FBM KLCI dipped slightly lower at to close at 1712 on Monday session as the China disappointing economic data and the BBOC refusal to cut uh, rates triggered the selling in the China proxy stocks. Also, yeah, I do note that our market is not moving in isolation, right? So sentiment are coming from different regions as well. And on the yesterday session, I think majority counters are experiencing profit taking during the start of the week, which seem to be broad based. If you look here, there's a lot of reds in the heat map. However, sectorial-wise, only three sector remains in green, coming from REIT, consumer, and also the finance sector. However, for the FKLI futures were closed unchanged as the volume dried up on the US market holiday yesterday, and traders refused uh, um, to open new position knowing that Wall Street is closed. So expect a very quiet, low trading session today, right? Um, uh, uh, in morning as the market wait for the US futures to reopen. So I think for the FLI, our resistance will remain back at 1730, followed by 1750, with our stop loss is at 1650 points level. So since we are talking about finance sector just now, So I think recently noticed that one of these bank stock that is but persistently on its bull run, which is Affin. So I think the downtrend has been breached since early of of the year, right? So we notice a reversal pattern of a double bottom as well right here. And in terms of a technical indicator, the 20-day moving average has crossed above the 50-day moving average, which makes a bullish crossover visible, right? So, and now if you see here, the MACD also is trending above its signal line, which tells us that the positive move is there. Uh, but then we do not discount any pullback to happen right here. So if you recall the way we detect for the I mean uh, for end of the pullbacks actually using Fibo retracement, and you can pull from A to B to find the golden ratio level of using the Fibonacci retracement, right? So for now, we see the immediate resistance is at 2 ringgit and 77 cent, 2 ringgit and 87 cent, together with the 2 ringgit and 97 cent for the resistance, and it is remain strong for now, right? So moving on to our this is a watch list for today, right? And for our uh, trading stocks, we have KLK, Kuala Lumpur Kepong, which is one of the biggest plantation company in Malaysia. So the stock is in its pending breakout at the 20 ringgit and 40 cent level on a strong volume. So with that, we expect the momentum to keep bullish and the stock able to propel higher towards the level of 21 ringgit together with 21 ringgit and 40 cent. And if the stock to clear below this 20 ringgit support, this could reverse the cost and trend lower. Also next, we have Eversendai Corporation, which is an engineering company. So the stock is experiencing a breakout as well at the 45 cent level. And if the stock to remain bullish, you expect the price to reach higher towards this 48 cent level in the coming session. Second resistance at 51 cent level. So keep an eye at the 42 cent support for any attempt of reversal. So today we have one breakout stocks, which is Eversendai, and also one pending breakout stocks for the KLK, right? So if you look here for the FCPO, well, it closed slightly lower yesterday to close at 40.69, dropped by 3 ringgit. Sentiment was dragged down by the China's weak economic data, which also sparked fears in demand that our demand from the biggest buyer will remain sluggish post Chinese New Year. However, losses were limited as the data for the first half January showed that the production plunged uh, around 40%, reminding the seller that supply is getting very tight due to the ongoing season. Also, later we have Hilmi to talk more about the plantation side of things, so do stay tuned for that, right? And expect for this FCPO, expect the price to trade sideways or slightly higher today, right? As the market oversold it. And the sharp drop in the production is starting to offset the demand fears. So our resistance is at 4,100 and our stop loss is at 180. We are eyeing for the 3,900 together with 3,830. Right. So that's all I have for today. Thanks everyone. Thanks for listening. Happy trading and see you again. I pass the floor to Hilmi. Thank you.
Hi everyone, thank you, Aiman. Good morning, everyone. So today I'm presenting a company update on Sarawak oil palms on behalf of Lileng. We expect that 4th Q 2025 core PATAMI to rise 10 to 27% quarter on quarter, reaching potentially somewhere around 130 to 150 million in what should be the strongest quarter for the year. This is mainly driven by higher FFB output, which is up 16%, higher CPO output, which is up 32% Q on Q, and higher PK output, which is up 39% Q on Q. So we expect this big growth in volume should more than offset the moderating ASPs, where we see the CPO and PK prices are down quarter on quarter. So for the whole FY 2025, this brought the FFB growth to 3.13%, higher year on year, which exceeds our expectation of only 2.65%, while CPO output declined only 1.4% and PK grew 2.3%, which is significantly outperforming our earlier expectations. So this was slightly supported by higher than expected external FFB purchase, which is estimated to increase 1.8% year on year. Hence, we raised our external FFB purchase assumptions accordingly for FY 25 to FY 27. On unit cost productions, with the improved FFB output, which is higher 3.13% year on year, management sees that the production cost in FY 2025 to be lower year on year, from 2,600 ringgit in 2024 to 2,400 to 2,500 per ton level in 2025. This is mainly due to lower fertilizer prices, higher kernel credits, and internal processes streamlining. So management tries to keep the unit cost flattish in FY 2026, despite that they have secured 70% of fertilizer requirements at 15 to 20% higher prices year on year. So we remain conservative with the unit cost assumptions, and we forecast it to grow 6% in FY 2025 and 4% in FY 26 due to higher cost of fertilizer and aggressive replanting activities. On the downstream segment, although the disclosure is very limited, management noted that the downstream remains profitable despite lower utilizations of around 80% for 9 months 2025 as compared to 9 months 2024, which they utilized 90 to 95%. They reached the utilization rate of 90 to 95%. So challenges remains particularly in India, but SOP is actively seeking better pricing and higher quality buyers outside of India. So with that said, we still expect margin pressures given stiffer competitions and Indonesia exports levy changes starting March 2026. On the dividend side, SOP has indicated that higher dividend payouts are likely once the net cash exceeds 1.5 billion ringgit. As of 9 months 2025, the net cash stands at 1.3 billion. Since we only expect that the threshold to be reached in FY 2026, so we forecast that FY 2025 dividend per share to remain at 12 cents, implying a 22.1 payout ratio. So for FY 2026 to FY 2027, we project payout ratios to rise to 25 to 27%, translating into dividend yield of about 3.7% per annum. So in conclusions, we raised our earnings forecast by 0.1%, 1.75%, and 0.5% for FY 25 to FY 27. Our new target price now is 4.22 ringgit from the previous TP, which was 4.44 ringgit and 50 cents. So this is based on unchanged 9 times FY 26 for PE after implying a 14% ESG discount in line with its ESG score of 2.3. That's all for me. Happy trading and see you all tomorrow. Thank you.